Hello everyone and welcome back to the Finance Zone. Today we're going to be talking about the top 5 stocks to buy in December of 2020. Make sure you stay until number 1 as you don't want to miss any of the information stacked up for you. For years, growth stocks have been beneficiaries of outsized gains compared to the averages. The main criteria we look for when betting on upside in a stock are improving fundamentals, great entry points, technicals, and a history of bullish trading activity in the shares. The hallmark way we go about finding the best stocks, the outliers, is by looking for quiet, unusual trading activity. Oftentimes, that can be institutional activity, i.e., big money. We'll go over what that big money trading activity looks like in a bit. Technologies represent a potential buying opportunity for the long-term investor. Given the strong historical revenue and earnings growth alongside multiple big money buy signals, these stocks could be worth a spot in growth-oriented portfolio. Before we ring in a new year, I'm pretty certain most folks will be glad to put 2020 in the rear-view mirror. That includes Wall Street professionals and retail investors who've been whipsawed by extraordinary levels of volatility over the past 9 months. However, periods of heightened volatility are usually blessings in disguise for opportunistic investors with long-term mindsets. Even with the benchmark S&P 500 at an all-time high, investors can still buy into great companies at fair valuations. Number 5. Cresco Labs. Don't look now, but marijuana stocks are blazing hot once again. This time around, the immediate and long-term outlook for US and Canadian pot stocks is very different. There's little question that you'll want to invest your money in US marijuana stocks with vertically integrated multi-state operators, Cresco Labs, OTC, CRLBF, at or near the top of the list. Cresco Labs' operating model has 2 major revenue generators. Retail sales through its 19 currently operational dispensaries are the first. Cresco holds enough licenses to open as many as 29 retail stores in up to 9 legalized states, but it's concentrated on the land of Lincoln. Approximately half of the company's operational dispensaries are located in the limited license state of Illinois, which should be a $1 billion annual market by 2024. The mere fact that Illinois is a limited license state gives Cresco a good opportunity to gobble up significant market share. Perhaps the more exciting growth driver for Cresco, though, is its wholesale cannabis business, which is the largest in North America. When Cresco completed its acquisition of Origin House in January, it inherited a very lucrative cannabis distribution license in California, the biggest marijuana market on the planet. With this license, Cresco can now put cannabis products into more than 575 dispensaries throughout the Golden State. In the September-ended quarter, Cresco produced over $90 million in wholesale revenue. Cresco generated $128.5 million in sales in 2019. Wall Street is now looking for $477 million in full-year sales this year, over $800 million in 2021, and for the company to decisively push into recurring profitability by next year. It has all the makings of a long-term winner in the pot industry and should be scooped up by growth-seeking investors in December. Number 4. Annaly Capital Management. I have a treat for the income seekers out there. The company borrows money, primarily via short-term repurchase agreements, and reinvests the proceeds in asset-backed securities. As of December 31st, 2019, 93% of the company's assets were mortgage-backed securities issued by either Fannie Mae or Freddie Mac. The company generates profits from the net interest spread between the interest earned from its assets and its borrowing costs, which is amplified from the use of leverage. As of December 31st, 2019, the company had a debt-to-equity ratio of 7.2. Though it's largely been shunned by Wall Street for the past 7 years, Mortgage Real Estate Investment Trust, REIT, Annaly Capital Management, New York Stock Exchange, NLY, is ripe for the picking. Without getting too technical, mortgage REITs borrow capital at short-term rates and buy assets with a higher long-term yield. In Annaly's case, we're talking about purchasing mortgage-backed securities, MBS. The difference between the yield generated from these MBSs and the short-term borrowing rate is known as the net interest margin, the NIT. The wider the NIT, the more money Annaly makes, and the more the company makes, the higher its annual payout. Things were downright ugly for Annaly Capital Management when the yield curve inverted and, for a brief period, short-term yields were higher than long-term yields. However, history has shown time and again that the early stages of an economic recovery feature a broad-based steepening of the yield curve. When combined with the Federal Reserve's dovish monetary policy, this should lead to a steady expansion of Annaly's NITs in years to come. Furthermore, Annaly predominantly purchases agency-only assets, This means its MBSs are backed by the federal government in the event of default. Although the yields on agency-only MBSs are lower than non-agency assets, the perceived safety of agency assets has allowed Annaly to use leverage to its advantage. The Annaly Capital Management's book value again heading higher. This is a 10.8% yield you're going to want to add to your portfolio for December and beyond. Number 3. Pinterest. Pinterest shares have already surged this year, but there are a number of reasons that December could be its best month yet. The fourth quarter tends to be the company's seasonally strongest period of the year as advertising spending spikes during the holiday season. This year could be especially fruitful for Pinterest because the image discovery platform looks perfectly positioned to benefit from a number of trends. First, e-commerce is set to boom this holiday season. With coronavirus cases spiking across the country and retail traffic sluggish, Pinterest has recently improved its shopping ads, which are integrated with e-commerce, and online sellers tend to prefer advertising on digital platforms like Pinterest. Americans still plan to shop this holiday season. In fact, the National Retail Federation forecasts holiday sales to rise 3.6 to 5.2% this year, a promising sign for Pinterest, as this early start to the holiday season, as CFO Todd Morgenfeld referred to on the last earnings call. The company's unique position as a network where users come to work on themselves rather than connect with others, and its focus on positivity also gives it an advantage over Facebook and other peers. The Facebook boycott from earlier in the year still seems to be driving advertisers away from the social media giant and to smaller platforms like Pinterest. And there are signs that small businesses are also dissatisfied with Facebook. Pinterest is targeting 60% revenue growth in the fourth quarter, and the company is well positioned for growth after the pandemic as its user base has surged during the crisis. And verticals that have historically been strong, like weddings and travel, will bounce back when the economy normalizes. Even with the stock having more than tripled this year, there's plenty of upside potential left in Pinterest. Number 2. C Limited. If you told your 1990s self that you'd be getting most of your goods delivered by Amazon, at the time just a bookseller, it would make no sense. That is, until you realize the company's ambition has always been, quote, to be the Earth's most customer-centric company, end quote. I get the same feeling about C Limited, which started out as a gaming company and has become so much more. An e-commerce platform with a payment solution that's growing very fast. All of this serves a larger mission, to better the lives of consumers and small businesses with technology. Consider how all three segments are performing, and you'll see that C, sorry I couldn't help myself, is well on its way to fulfilling that mission. Gaming, owner of one of the world's most popular freemium games, Free Fire, this unit saw total users jump 78%, while paying users more than doubled. That translated into bookings and adjusted EBITDA more than doubling year on year. E-commerce. By focusing exclusively on 7 maritime nations, Indonesia, Vietnam, Thailand, the Philippines, Malaysia, Singapore, and Taiwan, C is building out the fulfillment network to be the primary e-commerce player in the region. Last quarter, orders and gross merchandise volumes, stuff sold on the shop platform, more than doubled. There's a reason this multifaceted company is being called the next Mercado Libre. It has become a market leader in e-commerce and digital finance in Southeast Asia, whilst also having an impressive global gaming and an entertainment business. Its profitability could cause concern if it wasn't already growing at a fast enough pace to demonstrate that it will be profitable in the future. In particular, this company is positioned perfectly to benefit from the Southeast Asian internet economy, which reached $100 billion last year and is expected to triple by 2025. Investing in this company could present a high risk, but with a growth reward. Payment options. While still small, the C-Money digital payment option has seen rapid adoption. Total payment volume has been more than doubled in the last 6 months alone. All of these parts feed off of each other. That's especially true of the payment option, which could hook users by getting them to use C-Money during in-game purchases or on Shop's website. Such strong results are why, when trading rules allow, I'll be adding shares to my family's portfolio. Number 1. Walgreens Boot Alliance. Finally, investors who favor value stocks would be wise to gobble up shares of pharmacy giant Walgreens Boot Alliance, NASDAQ WBA. In December, the entire pharmacy industry was hammered last month after Amazon announced its entrance into the pharmacy business. This was always the expectation after Amazon purchased PillPack for $753 million in 2019, With deep pockets and a lust for market share, Wall Street is clearly worried about the long-term potential of predominantly brick-and-mortar pharmacy chains like Walgreens. I'm here to tell you that this company has a strategy to fend off Amazon and thrive, and it's already well underway. Walgreens has identified approximately $2 billion in annual expenditures that it plans to cut by or before 2022, all while reinvesting heavily in digitization. This should result in double-digit online sales growth and increased mobile pickup order usage. The company also announced a partnership with VillageMD in July that'll see the duo open about 700 physician-led clinics at Walgreens locations in over 30 U.S. markets. Walgreens is attempting to become a full-service medical destination at the grassroots level, with the goal of boosting demand at its higher-margin pharmacy. If the company can effectively bolster consumer loyalty and engagement with this partnership, it'll be well worth it. Value investors buying into Walgreens are getting a company valued at less than 8 times Wall Street's forward earnings forecast that also happens to be a dividend aristocrat. That's right, you'll get a 4.8% yield as the cherry on top of this deeply discounted value stock. Thanks for watching. While you're here, go ahead and click one of these 2 videos on your screen. And don't forget to like, subscribe, and leave any comments down below. We'll see you there, and thanks for watching.